Our next strategy is pretty much the one that is the most commonly used and commonly talked about and commonly suggested, which is index investing. So, what is index investing? Boom. Index investing is a type of investment strategy that involves buying a portfolio of securities that track the specific market indexes, such as the S&P 500 or the Nasdaq Composite. The goal of index investing is to achieve returns that are similar to the returns of the underlying index, where minimizing the cost. So it's pretty much pushing for ETFs. This is pretty much the ETF that tracks either the Nasdaq or the S&P 500. So that's the SPY, and it's very low cost. Again, these ETFs pretty much have like a 0.5% annual kind of cost. So you just put your money in there and set it and forget it. Index funds, which are a type of investment portfolio that track a specific market company, investors to perform index investing. These typically hold a diversified. So the point of an index investing is this: is diversified portfolio. So with the S&P 500, you're holding 500 pieces of companies of the biggest 500 companies in 11 different sectors. So that's why you're well diversified. So if one sector goes down, another goes up, and regardless whether it's value or growth, there's anything and everything in here. There's dividend as well. So everything that we have talked before, that's pretty much an index investing. And as I said, this is the most commonly recommended kind of type of investing. Investing in index investing is often considered to be low cost. Okay, you told us that. It's afforded. Index investing is subject to market risks and returns may vary based on the changes in the market conditions. So this is very important. When you're talking about index investing, it's the conditions that are market. So it's not stock specific conditions, but market conditions. And let's talk about that a little bit. So the benefit when you're investing in index funds is big. You are kind of taking out the risk of one potential company. Let's say you have three companies. You bought last year Facebook, Apple, and Amazon. But because Facebook went so much down, like it went from 300s down to the 90s, you lost 2/3 of the value of that company. So that's a significant risk and a significant hit to your portfolio. That being said, uh, indexes obviously that has a very low probability of happening. Like even in the pandemic, even the lows of the pandemic, the indexes were down around 30% from their pre-pandemic period. Again, and that was just 1 month, and afterwards they rebounded very quickly. But point is, when you're diversified in a lot of stocks, your portfolio won't sink by a tune of 40, 50, 60, 70%, right? Whereas if you have just one company or a couple of companies, you're very exposed to the individual risks of those companies. Whereas the problem is that with that, you're exposed to market risks. So the month of January of 2023, if you were invested in the Dow Jones, which was the biggest performer of 2022, now because we're thinking there might be some market risks, or even just it was a big performer in 2022, it's up by the smallest amount, around 2.5%. But if you have an individual stock or a couple of stocks, let's say you had Facebook, you bought it on the dip. You had Tesla, you bought it on the enormous dip. You had other companies like Block, which was also just hammered. And then throughout the month of January, these stocks have been on a tear, went up by 50, 60, like as we said previously, with Tesla, 80% in just 1 month. So that's what you are kind of missing with the market when you have index investing. Okay, you go with the market goes, and you can agree with that, you can disagree with that, you can like that or don't dislike that. But point is that it is really up to the market and up to the overall economy. So if the overall economy is doing good, you're doing good. But if the overall economy is doing bad, then that's where I think thinking about leaving indexes if you believe that there's rough times ahead, which I believe for 2023. I personally would not be in index funds because if the economy is going to go down, the indexes will go down. But that doesn't mean that there aren't stocks that you can purchase in that environment that will either held up really nicely or pay you a dividend or even grow in that kind of environment. So that's why when you are expecting the market to kind of go down, I would not recommend owning index funds. Although, as I said, the most commonly easy, just you put your money in, set it and forget it. And a lot of people just put money in there regularly every month, which is again a strategy, not a bad strategy, but I think that you are missing out on a lot of returns, especially if you do some research. Use the tools that we have right now, like tools like this, just super amazing, and hopefully that can help you boost your returns. Okay, let's see what it says if we ask it some examples. Obviously, it's going to give us the S&P 500, the Nasdaq, the Dow Jones, so S&P 500 index, 500 of the large cap US companies. Nasdaq, that's the more technology heavy, so a lot riskier and more volatile than the S&P 500 or the Dow Jones. The Dow Jones Industrial Average, that is 30 companies. The Nasdaq here, okay, so with the Nasdaq, because it said the composite, so the Nasdaq Composite Index, it's 3,000 US companies. The Nasdaq 100 is just 100 companies. So make sure if you're investing to check which one, because they're pretty much one by the other, and you might not notice, but there will be a difference because the Nasdaq 100 is the biggest companies like the Apples, the Teslas, the Amazons, and the Googles, whereas the composite, as you can see, there's 3,000 companies there. Dow Jones, as I said, 30 companies. This was pretty much the lesser performer than the Nasdaq throughout the years, but then 2022 was a surprise where the Dow Jones performed much better than the Nasdaq and the S&P 500, mostly because it had a lot of healthcare companies, pretty much UNH, United Healthcare. That's the most expensive stock, and because the Dow Jones is price weighted, so we can make another topic. I don't, maybe ChatGPT can answer that, and I can elaborate what is price weighted and what is market cap weighted. So these are market cap weighted. The Dow Jones is price weighted. So a company like UNH, which is $500 or now for something, if that company goes up by 1%, that's 5 points, $5 added to the index. Whereas a company, let's say back in the day, I don't know exactly, I don't track Coca-Cola, but Coca-Cola was $50 a couple of years ago. So Coca-Cola can go down 10% if it's $50, let's say. Walgreens, I think it's a cheap stock in the Dow Jones. But let's say a stock is $50. It goes down by 10%, that's -5. But a stock like UNH goes up by 1%, that's because it's $500. Then you have +5, so the index is flat, +5 by -5. Whereas with the S&P 500 is market cap weighted, so those percentage moves will be kind of put in place depending on how big of a market cap the company has. So keep that in mind. That's the difference, and we might make a kind of separate topic explaining that even better. Russell 2000, those are small caps, more risk, but in environments when there's kind of risk on, then these tend to outperform. They either outperform in the good way or the bad way. So even in good markets, higher returns; in bad markets, higher losses. MSCI index. I don't know this one. So this index is governed of stocks, developing markets. Oh, sorry. In Europe, Asia, and the Far East. So I do not know this index here. So I cannot talk about that one. Okay. That was a really nice topic with index investing. Hopefully you learned something, and then we're now gonna head to something else.